Hello again, students. Welcome back. Hope you had a good 3-day weekend. So what we'll do now is just talk a little bit about what you're going to see in this final chapter you'll read for this class in the Krugman textbook, Chapter 17 on the 2008 economic financial crisis, and as well the very weak economic conditions that we've experienced since then, both the big recession and the current really weak job market. Krugman's chapter here is pretty good. It's relatively readable, gives you a decent account of what happened, and also it kind of gives you a more basic idea of what economic crises are all about and why they tend to happen both historically and these days with some regularity, actually. That said, he kind of leaves the background out of the picture. So next week's lecture, which is one of mine, we'll deal with that in some detail, looking at the various forms of financial deregulation that were advanced in the 1980s and 90s. And we'll see how that kind of laid the groundwork for the financial crisis that Krugman talks about in Chapter 17. Just one or two things I wanted to mention, though, because sometimes they've proven difficult for students in the past. So one is the issue of bubbles, financial bubbles, that is. And you may have heard of these before, like the one that sort of led to the finance crisis of 2008 was a bubble in the housing market. So you hear about the housing bubble. So what are these things? Well, a bubble is a market development where the price of some asset rises wildly out of proportion with the value of the asset. So you have a very high price for something that people are buying and selling. And you can have bubbles in almost any type of asset. We've had them in stocks in the 90s, and housing and real estate in the last decade. Bubbles have been experienced with all different kinds of real and financial commodities. But a bubble takes place in a market where you've got a large amount of speculation. Now, speculation is a very basic financial phenomenon. You've heard of it. You may not know it. Speculation is simply where you buy an asset with the plan of selling it later for more. All right? Very basic sort of plan. So whereas investment is where you spend money with the plan of producing more in the future, like spending money getting your business new computers or building a new factory or branch office. That's investment. Speculation is where you buy some asset not because you're going to use it to produce goods and services, but because you're buying it because the price is gradually going up. And if you hold it for a while and then sell, you can make a profit. And this has become a major thing in our economy in this era of deregulated financial transactions. So if you've heard of flipping a house, flipping real estate, that's the real estate specific industry term for the practice of speculation. Right? Buying some asset with the plan of selling it later for more. And this can be for housing or anything else. Well, speculation is a very traditional practice. It's not even necessarily a bad thing. It helps markets arrive at prices. The big thing about speculation is that if it's completely unlimited, and if credit is relatively available and other conditions are right, kind of like a tornado, speculation can evolve into a full market bubble where the price gets out of control. And picturing that transition has been a little tough for students in the past. Let me try to maybe draw the connection for you. So just imagine that it's about 10 years ago, 2003 or 2002, and you work for some financial institution. Let's say you work at a trading desk for JP Morgan Chase Manhattan Bank in New York City, and you, like any asset manager, you've got, say, a couple $1 million of capital, probably from wealthier clients or maybe institutional investors like a pension fund. And your job is to use that money, that client money, and find a place to invest it as profitably and as possible at a given level of risk. Well, there are a variety of ways you could go about doing that. You might take that money and, say, use it for real investment. So take some of your clients' money that you're in charge of and use that money to create some loans to some different businesses. So loan money to firms, because those firms might use the money to get new equipment or expand the business by building new factories or the like. That will allow the firm to expand and gradually produce more products and be more profitable and pay off the loan plus interest. Okay, that's a possible option as a money manager that you might think of, but it is somewhat risky, right? Investment is typically a long-run phenomenon, generally speaking, at a larger scale, and that tends to mean that you're taking the risk that maybe in 3 years, when this new factory is built, what if there's a recession happening then, and we can't sell the products made in this fancy new factory? So it's risky, and it's a relatively slow process making a profit from that money. On the other hand, suppose that you take that investor money and rather than investing it in some firm, suppose you instead use it for speculation. So it's 2003, and you notice that housing and real estate in Florida is going up in value on an ongoing, regular basis for legitimate supply and demand reasons, right? Old people love moving to Florida, and they do. I don't get it, but they're very excited about it, so more power to them. So suppose you think, well, okay, housing and real estate and condos and so on in Florida are reliably going up in price. Why don't I buy some of those assets and then hold them for 6 months or a year and then sell them? If the price is going up quickly, you can make a sturdy profit from it, and you can operate in a much smaller time scale than you would if you were engaged in real investment with some business. So that's sort of the allure, the attraction of speculation relative to real investment. It's relatively quick, and it can be more profitable frequently. All right, well, suppose you start doing that then. Okay, you use your client's money and you buy up a bunch of real estate or condos or apartment buildings or houses in Florida and California and Nevada and Phoenix, places where the housing price trends were going up steeply. Well, you'll make very strong returns very quickly doing that, but then suppose you're having some success doing that, and I work for the same company and my trading investment desk is across the hall from yours. If we start talking at the water cooler, I'm going to hear about your great speculative investment strategy, and I may very well start doing the same thing, right? Why don't I do what you're doing? It's working out so well. You're making a lot of money for your clients very quickly. Why don't I consider doing that? There's no reason, nothing preventing me from doing that, right? So now I'm buying real estate and condos and houses in Florida and California, just like you are, holding them for a while and selling them. And then suppose other people at our business start doing that, and other people at the other large investment houses and brokerages and big Wall Street banks start doing the same thing. What's going to happen is that eventually you'll have enough speculative investors like us buying up these assets, planning to sell them later for more. If enough of us do that, that creates new demand, more demand for this housing, just to resell it later, but it's demand if we're willing to pay. If enough of us do that, that itself will start to drive up the price. Okay, rather than senior citizens wanting to retire in a sunny environment. Okay, just the strong presence of our Wall Street short-term investments creates demand for the same housing stock. And housing is relatively inelastic. It takes a long time to build, so it's possible for that price to get pushed up. And eventually, if enough of us are doing that, if enough of us are speculating in the industry, it can create that upward pressure on the price, and it creates kind of a self-fulfilling prophecy, right? We're buying these products, these housing assets, because we think they're going to go up in price, and if enough of us make that move, it will push the price up on its own. Right? It's a self-fulfilling prophecy. That's a bubble. Okay, it's when speculation reaches a significant scale that it itself is driving up the market price that everyone's looking at. That's when it goes from being just some speculation, which happens all the time, to being a full-on market bubble, like we saw in housing in the last decade, in which Krugman's going to discuss in chapter 17 of your book. So he talks about asset bubbles in there and gives you the basic definition, but you'll want to know for the final later what the relationship is, basically, between speculation and a bubble. And speculation just means buying some asset with the plan of selling it later for more. A bubble is where so many market actors are engaged in speculation relative to the size of the market that our buying is enough to push the prices up and keep them elevated, which of course encourages us to speculate more, right? The price is still going up. Bubbles eventually always pop, of course. This is not sustainable. And that can happen for different reasons. If something happens to spook investors, or if it becomes more expensive to borrow money, because borrowing money is often involved in buying this large amount of property, right? So if the Federal Reserve raises interest rates, that can scare people out of the market, lead the price to finally drop. And when the price stops rising after all those years of the bubble, that's when people panic sell and the bubble always crashes. And bubbles can pop on their own too. So if you and I both have these big speculative investments in, let's say Florida real estate, and suppose I sell a large amount, like several $1 million worth of properties, and you do the same thing just by coincidence, a profit-taking step, selling off these houses and such that we bought for less. If we do big enough sales of these assets within a short enough period of time, what do you think that's going to do to the price? Exactly, audience. It's going to lead the price to finally drop a little bit as we drop a big old hunk of these assets back on the marketplace. So just the normal to and fro of the bubble eventually can lead to its own undoing, because when everyone's used to that price going up and up and up over time, when it finally goes and drops a small amount, that's when everyone completely loses it and thinks, ooh, the price isn't going up anymore, I better sell this asset that I've been speculating on. I'll be the first to sell. Pretty smart, right? And of course, everyone's thinking the same thing, right? So everyone ends up selling at the same point, which creates an environment of hasty sales, often at a loss, which we call panic selling, where you're trying just to get some of your liquidity out of that asset. And it means that the price of this commodity, like housing, which for years, bubbles last for years, which for years has been trending up and up and up and up and up, goes like that. Okay, so you'll see that turn up in the bubble. And the fact that so many large, very large American banks, the institutions that we call mega banks, the fact that they were so heavily invested in this bubble meant that when it went kaput, the banks got shoved to the edge of bankruptcy. And Krugman covers those events of the crisis very well. So focus on that this week on Chapter 17. You'll find the rest of your week's materials are up on the course. And then next week, you'll see the background a little bit and look at some related subjects. And that'll be the term. All right? See you on the discussion boards.